You pointed out that a quarter of issuance right now is coming from AI, mostly to fund data centers. Is this just an initial first wave as we try to catch up with the compute necessity, or is this just the dominant theme from here on out?
You know, I think the number one theme that our investors are focused on right now is hard assets in the infrastructure build out. If you think about AI and the CapEx associated, we really think that this is just a generational opportunity. If you look at the US, we think you're going to need double as much power for data centers over the next couple of years. And the hyperscalers have said that they're going to spend $600 billion this year alone on AI CapEx. And so what we're seeing is that there's just a really big opportunity to finance this CapEx across all the markets that we touch: investment grade, bank market, high yield, and structured products. But in the high yield market specifically, as you mentioned, it really has been the dominant theme this year, 20-odd% of issuance, and we think that's going to continue. It's data centers, it's chip finance now, and it's power too, but that's absolutely what our investors want to focus on right now.
And I know you have a panel on this later, so I would love a little preview, because it's an interesting conundrum to say, yes, this is hot. We need this stuff. But what the world looks like in 5 years is so unknown. There are huge tails on both sides of this thing. Right. Either it's a disruptive force that completely reshapes society, or we go too far. How is this market treating those kinds of risks? Are they being priced in yet?
So look, I think there are some natural checks when you think about the amount of development that can happen: land availability, power availability, and then just the long lead time for a number of these items. So that is providing some natural constraints for the market. But what I do think you're going to see, particularly in the leveraged finance market as we get more data, is differentiation based on track record, based on ability to deliver large projects on time and on budget. And if we have more data, we think that the market will start distinguishing more. But I think the backdrop is going to continue to be really strong, because this is a generational opportunity to help with this CapEx build out.
What do you think fuels that differentiation to come into the market? Because at the moment, it just feels like a frenzy, and that investors can't get enough, and they have the money to put towards it.
Yeah, so I think it's nuanced. I think it's lease structure. Do you have termination options if you're late in delivering the space? Who is your tenant? Are they investment grade? Are they non-investment grade? Where is the project located? How long is the lease? So it's very much a project finance type of backdrop.
So we also have had a very healthy issuance, especially this spring. How much of this has just been a backlog versus new robust activity in LBOs and otherwise?
So, you know, Q1 was a big quarter for M&A, but a lot of it was focused on sponsor and strategic activity, more than 25% up in total, but very concentrated there. The sponsor backlog is actually relatively light right now as we look forward, because so many of these transactions have been kind of financed in the IG market rather than the high yield market. So we've actually worked through a lot of the M&A backlog. I think that's positive for technicals as you look forward, given there's not a lot coming outside of AI. But I think longer term, we're optimistic that sponsor activity returns. A lot of capital on the sidelines. DPI pressure remains front of mind.
But haven't we had that for some time, Miriam?
We have had it for some time.
So what finally brings sponsors back to the table?
You know, maybe it's the AI build out. I think a lot of our sponsors have shifted their focus to these hard assets. We're seeing some activity in healthcare. We're seeing activity in industrials. So I think it's going to be in this hard asset sector and infrastructure build out.
Is there a sort of, I mean, usually it's crowding out when you talk about government spending, but is there any sort of crowding out when it comes to AI? Unless you're spending on hard assets, unless you're coming to the bond market with those types of debt offerings, is there not a lot else that's attractive out there? If you separate some of the AI infrastructure plays, what does the rest of the market look like?
Well, look, I think you're going to see muted activity around software for a period of time. Even if you can distinguish winners and losers, there's probably going to be a large bid ask between buyers and sellers for a period of time there. So I don't think we're going to see activity there. I do think we'll see activity around staples, around healthcare. Europe is getting more active for the first time in a while. So we think we'll be busy, but it's going to be sector specific.
So software still feels toxic. Is there any signs of that changing?
You know, I think the market has stabilized around certain names, so I wouldn't say that it's toxic. I think it's more that you may not see big transaction activity until that gap between buyers and sellers gets closer together.
And spreads remain tight despite all of the volatility, despite inflation figures. I know we're going to talk with your chief economist in a bit. Inflation figures that are the highest annually since 2023. The war in Iran is still going. The Strait of Hormuz is still closed. Credit spreads as tight as they are, is it just because everything is great with AI in the economy, or is there some complacency in this market?
Well, we are seeing bifurcation in the market. So if you look at the total credit spreads, to your point, we have basically retraced what we saw widening in February and March, really back to almost all-time tights on a, going back to 2007 basis. But I think if you look under the hood, the market is differentiating. We're seeing a lot of desire for clean credit stories, and those names have really traded up. But if you look at software and if you look at other sectors that maybe are more sensitive to inflation and some of the effects of the war, I think those names have traded down. So I think the market is doing a good job of differentiating. But to your point, there's not a lot of supply coming. And so when you see a good new money name, people kind of do have to pile in right now.
Is there a scenario where some of those more interest rate sensitive sectors, that it spills over into the wider market? This was said also of software, that maybe it becomes like energy in 2014, that it has a greater impact. Are these things, can they remain isolated, or are there any concerns that it could lead to greater credit market ruptures?
We haven't really seen that so far. So I think if you look at Q1, earnings were pretty strong across the board. I think the economy has been able to absorb a lot of these inflation considerations. That's part of why rates are higher now, because growth has continued to be strong. So I don't think we see anything that's systemic at this point.